Hey, thanks for choosing this video to watch. I'm pretty sure you're already interested in investing or finance or wealth generation, because these are the kind of topics we address in our videos, and I'm pretty sure in the future videos you'll love the content that comes out. So if you like this video till the end, do subscribe. Don't have to turn on the notifications, we don't want to bug you, but do watch these videos in your free time to gain this knowledge for free that ideally universities charge a lot for. So let's get started with the video and hope you'll enjoy. Hi, so this is the S&P 500. And why we are talking about this? If you look at the 2008 crisis and look at the current crisis due to COVID-19, the fall was much higher right now. And we have seen that whenever a market falls, the recovery makes the returns worth it if you invest after it falls. Meaning, if you would have invested at this point in time, in 2009, at 683 USD, and you have waited for another few years, let's say up to 2018, meaning just for 9, or let's say just 10 years, you would have received almost 4 times the investment, more than 4 times, 4.5 times. Your money would have increased that much, and that's a big gain. It's not a small gain. Now, why is this important, and why is this linked to mutual funds? Now, mutual funds are funds that are not exactly linked to S&P 500 or any index, but index funds are. Now, why do I talk about index funds and mutual funds? If you look at this right here, mutual funds will tend to cost you more in fees. Now, what are the fees? The fees that you pay the company that manages these funds for you. That is the asset management company. The fees range from 1 to 3% for mutual funds, and index funds, on the other hand, the fees are as low as 0.05% to 0.07%. It's too low, and that is the reason why you won't see index funds being marketed heavily on TV. Whereas mutual funds, you can see the advertisements going around everywhere. The reason is simple, that they get more money. My advice to you is, do not invest in a mutual fund that you don't know. Instead, just invest in an index fund that you don't know. That is going to be much better. Why? Because the index fund is a fund that mimics or replicates or follows an underlying index. It could be S&P 500, it could be Bombay Stock Exchange, BSE, top 30, that is the Sensex, it could be Nifty, it could be top 50, right? So it could be anything. It just mimics an index. Now, why is that important? The index will not usually give you a bad return after the market falls. Now, if I was to tell you that, look at the 2008 crisis. The markets have crossed much more than what happened in 2008. Right now, I'm talking about right now. So it crossed around 30%, I think. The fall was way higher. Too much fall. And this is a good time to put your money in, because we have noticed that after the fall goes away, the markets recover like crazy. All the same thing for the S&P 500. It went from $683 suddenly to $921. Right? Your money just got 50% return in less than a year, and that is incredible. Now, why I'm talking about this? Simple. The index won't betray you. Why do I talk about that? Because the index represents some of the top companies in the world and collectively talks about them. And a company that goes bad will slip out of the index and new company will come. When you invest in an index fund, you're actually investing in the index and not the company itself. So even if a company goes bad and falls off the top 500 in the S&P 500, a new company comes up, right? So what I'm trying to say here is, it's much better to invest in an index than to invest in a mutual fund. That's right, because the index is as good as a mutual fund. Now, some mutual funds could deliver huge returns, up to 23% CAGR per year, right? But it is not for every mutual fund. Now, if I talk about S&P 500, there's one index fund here, basically the Vanguard 500 index fund investor shares. If I look for the maximum, look at this potential, what has happened. In 2008 also, if you look at the fall was not that high. Even right now, the fall in this fund is lesser than what happened in the market. So someone who invested over here at 71 and cash is out somewhere over here, let's say even over here, the person got roughly 4 times returns again. So what I'm trying to come here is, even over here you would see that the index beat the index fund as well. Yeah, that's right. The index fund has a return of close to 4 times in a span of 10 years, but the index has a return of more than 4 times in a span of 10 years. And that is why it's a good time to invest in S&P 500 right now. Looking at the track record of what has happened so far, as soon as the market falls to a steep level and starts recovering, the recovery is speedy as well. And that is why Wealth Workout advises those of you who are looking to invest in S&P 500 right now. Look at the Bombay Stock Exchange. The same thing has happened. So why we keep vouching about index funds is because they are also going to increase your returns by 2 to 3%, because these fees are going to go away, right? And these are not fees that are one time, right? So every year you're going to add that much percentage to your returns. And that is exactly why it's a lot better to invest in index funds, and many investors, even the top businessmen, talk about this. But it is not marketed heavily on the internet or on TV for the very same reason, that the fees are not so lucrative for the company that is managing it. So if you learned something new, please leave a thumbs up to this video, and we'll understand that this content was really helpful. Thank you for watching, guys. This is Wealth Workout. Hope you have a good time investing. Take care and stay safe.